In April 2020, the United States lost 20 million jobs in a single month. Unemployment hit levels not seen since the Great Depression. Entire industries were shutting down. And yet, the stock market was climbing. By June, the S&P 500 had erased all of its pandemic losses. How is this possible? How can the market thrive while millions of people are struggling? If you've ever felt confused watching stock market celebrations during times when ordinary people are suffering, you're not alone. The disconnect seems absurd, but it's not random, and it's not a glitch. It reveals something fundamental about what the stock market actually measures, and more importantly, what it doesn't measure. Today, we're going to dismantle the myth that the stock market reflects the health of the overall economy. We'll explore 3 critical reasons why markets can soar, even as businesses close and unemployment rises. By the end, you'll understand why tracking the market tells you almost nothing about how most people are actually doing. Let's start with the most important point. The stock market and the economy are not the same thing. The economy includes everything, every business, every worker, every transaction. It's the restaurant on your corner, the freelance designer working from home, the construction crew building houses, the hair salon, the local bookstore. Most of these businesses aren't publicly traded. Most economic activity happens far away from Wall Street. The stock market, by contrast, represents only publicly traded companies. In the United States, there are roughly 30 million businesses. Fewer than 4,000 are publicly traded on major exchanges. That's about 0.01%. But here's what makes this even more skewed. The stock market is dominated by giant corporations. The top 10 companies in the S&P 500 represent nearly 1/3 of the entire index's value. Companies like Apple, Microsoft, Amazon, and Nvidia. When people say the market is up, they largely mean these massive technology and financial corporations are doing well. These giants operate globally. Apple makes most of its revenue outside the United States. When the American economy struggles, Apple can still thrive by selling iPhones in China, Europe, and India. Amazon can be growing in cloud computing services sold to corporations worldwide, even while American small businesses are collapsing. So right away, we can see the first reason for the disconnect. The stock market measures the performance of a tiny slice of mostly enormous global corporations. The economy measures everything else. These are fundamentally different things. The second reason involves time. The economy tells you what's happening now. The stock market tells you what investors think will happen in the future. When you look at economic data, you're seeing current reality. Unemployment numbers reflect people who are out of work today. GDP growth measures economic output from the last quarter. Retail sales show what consumers spent last month. It's all backward-looking, or, at best, current. Stock prices work differently. When you buy a stock, you're not paying for what the company earned last year. You're paying for what you believe it will earn over the next 5, 10, or 20 years. The stock market is a prediction machine, constantly trying to price in the future. This creates a strange dynamic. Imagine the economy enters a severe recession. Millions lose their jobs, businesses are failing. By any measure, things are bad right now. But investors are asking a different question. How long will this last? If investors believe the recession will be short, perhaps 6 months, and that government intervention will stabilize things, and that these same companies will emerge and thrive afterward, they'll start buying stocks now while prices are low. They're not celebrating the current suffering, they're betting on recovery. This is exactly what happened in 2020. Yes, the immediate economic damage was catastrophic. But the Federal Reserve announced it would pump trillions of dollars into the financial system. The government passed massive stimulus programs. Investors concluded that, while things were terrible in April, they would likely improve by the end of the year. They were buying the recovery before it happened. Here's the crucial part. Investors can be completely wrong about the future and still drive prices up in the present. The market reflects confidence, or perhaps more accurately, it reflects consensus expectations. If enough investors believe recovery is coming, stocks rise, regardless of whether that recovery actually materializes. There's also a darker element here. Sometimes what's bad for workers is good for companies. During recessions, businesses can cut wages, reduce benefits, and lay off staff. This decreases their costs and increases profit margins. Investors see more efficient operations and higher profitability, and they reward this with higher stock prices. The market can literally rise because companies have successfully pushed pain onto their workers. The third reason is about ownership. The stock market doesn't represent most people because most people don't own much stock. According to Federal Reserve data, the wealthiest 10% of American households own approximately 87% of all stocks. The bottom 50% own essentially nothing. For most families, their largest asset, if they have one, is their home, not their investment portfolio. This concentration creates a fundamental divide. When the stock market rises, it primarily benefits people who are already wealthy. When the economy struggles, it primarily hurts people who depend on wages for survival. Consider two scenarios. In the first, unemployment is low, wages are rising, small businesses are thriving, but stock prices are flat. In the second, unemployment is high, wages are stagnant, small businesses are closing, but stock prices are soaring. The wealthy prefer the second scenario. Everyone else prefers the first. This is why you'll sometimes hear wealthy individuals and financial commentators celebrating market gains during times of widespread hardship. They're not being callous. Exactly, they're just experiencing a completely different economic reality. For someone whose wealth is primarily in stocks, a rising market genuinely means they're doing better, regardless of what's happening to everyone else. There's also a mechanism that amplifies this divide: monetary policy. When the Federal Reserve responds to economic weakness by lowering interest rates and purchasing assets, it directly boosts stock prices. This is intentional. The theory is that higher stock prices create a wealth effect, making people feel richer and more likely to spend, which stimulates the broader economy. But this transmission is weak and uneven. People who own substantial stock portfolios do feel wealthier and might spend more. But this doesn't help someone who lost their job and has no stocks to begin with. The policy inflates asset prices, which helps asset owners, while doing little directly for people who survive on wages. There's one more factor worth understanding. Some companies genuinely benefit from economic turmoil. During the 2020 pandemic, millions of workers suffered, but Amazon thrived. With everyone staying home, online shopping exploded. Zoom became essential for remote work. Netflix gained subscribers. These companies weren't just surviving the crisis. They were the beneficiaries of it. This pattern appears in different forms during various kinds of economic stress. During periods of inflation, energy companies and commodity producers often see soaring profits, while consumers struggle with high prices. During financial instability, certain financial institutions positioned to take advantage of distressed assets can profit enormously. The stock market, being heavily weighted toward large corporations, captures these winners. The economic pain gets distributed across millions of workers and small businesses who aren't represented in the major indices. So the market can rise, reflecting genuine gains for specific companies, while the broader population suffers. So when you see headlines celebrating market highs during times of economic hardship, remember what you're actually seeing. You're seeing the performance of a small number of enormous global corporations, not the health of all businesses. You're seeing investor predictions about the future, not measurements of the present. You're seeing gains that accrue primarily to the wealthy, not prosperity shared across society. And you're sometimes seeing companies profit from the very conditions that are causing others to struggle. The stock market is useful for what it actually measures: the collective valuation of large, publicly traded corporations. But it tells you almost nothing about whether ordinary people can find good jobs, afford housing, or build stable lives. It measures one narrow slice of economic activity, and that slice is largely disconnected from the daily reality of most people. The next time someone points to a rising market as evidence that everything is fine, you'll know better. The market can be doing well precisely because everything is not fine for most people. These are different measures, reflecting different experiences, benefiting different groups. Understanding this distinction won't change the system, but it clarifies what's actually happening. And that clarity matters, especially when people try to use market performance to dismiss legitimate concerns about economic hardship. The market rising doesn't mean the economy is healthy. It just means investors are optimistic about corporate profits. Those are not the same thing. Thanks for watching. If you liked the video, consider subscribing to The Business Paradox.